During the 2008 financial crisis, everyday people were losing their jobs, their homes, their life savings, basically everything they had. But Wall Street CEOs, the very people who helped cause the crash, were walking away with millions in bonuses. Not only did this anger people, but people started to protest. The very people who created this mess were cashing out in millions, while honest taxpayers were left with nothing. Usually, board members are supposed to oversee CEO pay and make sure it's justified. But they also did nothing. The board members are most of the time just friends of the CEO or end up developing a very friendly relationship with the CEO. In this video, we're going to look at just how much money these CEOs made during the crisis. But before that, we will quickly see how, in normal conditions, a Wall Street CEO gets paid. These CEO payments are a bigger package that includes base salary, performance-based bonuses, stock options, and long-term incentives. The base salary is often the smallest part, usually around $500,000 to $1 million for CEOs of the big bank. The real money comes from the bonuses and stock-related compensation. Short-term bonuses are typically based on the company's performance over the year. If profits are high or the stock price rises, the CEO receives a big bonus. These bonuses are often paid in cash, stock, or both. On top of that, CEOs are given stock options, which let them buy company shares at a fixed price in the future. If the stock price goes up, they can make millions. The idea is to align the CEO's interests with those of the shareholders. But in practice, this system can be easily abused. CEOs can take short-term risks to boost the stock temporarily and trigger their bonuses, even if those risks hurt the company later. Now, let's look at a real example of Lloyd Blankfein, the CEO of Goldman in that period. In 2007, Blankfein was paid a massive $68.5 million. That amount made him the highest-paid CEO on Wall Street in 2007. His compensation included a base salary of $600,000, but the majority came from performance-based bonuses and stock awards. On Wall Street, bonuses are awarded at the end of a fiscal year based on that year's performance. So, when Lloyd Blankfein received $68.5 million in compensation in early 2007, it was based on Goldman's performance from January 1st to December 31st, 2006. The bonuses are typically approved and paid in the first quarter of the following year, after full-year results are finalized and audited. But much of Goldman's profit in those years came from betting against the same mortgage-backed securities that their clients were buying. So while the numbers looked great in the short term, the long-term damage was already done. Goldman had an even better year in 2007 than 2006. In 2007, they made $11.6 billion. So, if the system had worked as usual, Blankfein would have received an even bigger bonus in 2008 for that record performance in 2007. But 2008 was a different world. The financial crisis exploded and people were furious. Congress was dragging bank CEOs into hearings, and Goldman had accepted $10 billion in taxpayer bailout funds. Any giant bonus paid in 2008 would have caused a massive backlash. So, Goldman's board skipped bonuses entirely that year for top executives, including Blankfein. It was a strategic decision to avoid public and political outrage, not because the firm couldn't afford it, but because it looked bad. Blankfein's 2008 compensation was just his base salary of $600,000 and no bonus. In 2008, Goldman didn't lose money, but their last quarter was brutal. They still ended the year with a profit of $2.3 billion, though it was much lower than the $11.6 billion they made in 2007. But Goldman was doing much better compared to other banks, which were collapsing. You can watch this video on the channel to know how Goldman saved itself from collapse. In 2008, Goldman recovered quickly. Their net earnings for the year were $13.4 billion, and they repaid the $10 billion in bailout funds by mid-2009. In fact, 2009 was one of Goldman's most profitable years ever. Because of that performance, the board awarded Lloyd Blankfein a $9 million compensation package in early 2010. If you thought that was a lot of money, wait until you hear about the man at JP Morgan. Jamie Dimon wasn't just surviving the crisis, he was effectively navigating through it. In the years leading up to the 2008 crisis, Jamie Dimon was one of the highest-paid CEOs on Wall Street. In 2007, he earned $39.1 million for JP Morgan's strong performance in 2006. This included a $1 million base salary, a $14.5 million cash bonus, $13.8 million in restricted stock, and $9.8 million in stock options. At the time, Dimon was praised for steering JP Morgan through a relatively conservative approach, avoiding the high-risk mortgage exposure. For JP Morgan's performance in 2007, Dimon was given $27.8 million in early 2008. This package included the same $1 million salary, another $14.5 million cash bonus, and $12.3 million in stock-based compensation. JP Morgan remained profitable in 2008 when the financial crisis was forming, and the bank had started building reserves for potential losses. In 2009, after the full-blown collapse of the global financial markets, Jamie Dimon voluntarily took a dramatic pay cut. For his performance in 2008, he accepted just $1 million, his base salary, and declined any bonus. In 2008, JP Morgan had accepted $25 billion in TARP bailout funds. By 2010, as the financial system began to stabilize, JP Morgan repaid its TARP funds. For JP Morgan's strong 2009 performance, Dimon received $17 million in total compensation, composed of a $1 million salary and $16 million in restricted stock. However, he continued to refuse any cash bonus, signaling that the reputational wounds of the crisis had not fully healed. Jamie Dimon is one of the most respected CEOs on Wall Street, according to other CEOs. You can watch other CEOs' opinions on Steve Eisman's podcast. We also know him as the real-life Mark Baum from The Big Short. While Dimon managed to steer JP Morgan clear of the worst, not every CEO had that luck. Enter John Tain, the CEO of Merrill Lynch. John Tain took over as CEO of Merrill Lynch in December 2007, just as the financial crisis was accelerating. In his first few months, Merrill had already suffered billions in subprime-related losses under his predecessor, Stan O'Neill. Despite the chaos, Tain negotiated a $15 million signing bonus for himself upon joining, along with a base salary of $750,000. His total expected compensation package for 2007 was around $17 million, even though Merrill had posted a record $7.8 billion loss that year. But what drew massive public and political backlash was Thain's bonus request at the end of 2008. Despite Merrill Lynch losing over $27 billion in 2008 and requiring a $10 billion TARP bailout, Thain reportedly requested a $10 million year-end bonus for himself. He justified it by claiming that without his leadership, arranging the emergency sale of Merrill Lynch to Bank of America would not have been possible and the firm might have collapsed entirely. However, due to public outrage and pressure from lawmakers and Bank of America, the bonus was ultimately not paid. In early 2009, when it was revealed that Thain had approved $3.6 billion in bonuses to Merrill Lynch executives just days before the Bank of America merger closed and before the firm's massive losses were disclosed. At the same time, he'd spent over $1.2 million renovating his office, including a $35,000 commode, a $1,400 wastebasket, and an $87,000 rug, all during the height of the financial collapse. These extravagances, coupled with the bonus scandal, sparked national outrage. Thain was forced to resign from Bank of America in January 2009, just a few weeks after the merger. His story became one of the most visible examples of executive excess and lack of accountability during the financial crisis. Even though he received no bonus for 2008, the damage to Merrill's brand and his own was already done. But Thain's story doesn't end with him, because Merrill eventually landed in the hands of another man known as Kenneth Lewis of Bank of America. Kenneth Lewis was the CEO of Bank of America during the 2008 financial crisis. In 2007, he earned around $24.8 million, which included a base salary of $1.5 million, a cash bonus of $4.25 million, stock awards, and options. It was based on the bank's performance in 2006. However, in 2008, things took a dramatic turn. In that year, Bank of America made two controversial acquisitions. Countrywide Financial, and Merrill Lynch, which were collapsing under the weight of subprime losses. These decisions eventually led to enormous losses, and they triggered government bailouts and put Lewis under intense scrutiny. Despite the financial chaos, Bank of America received $45 billion in TARP bailout funds. Kenneth Lewis still received a total compensation of around $9.9 million in 2008, mostly in the form of stock and deferred compensation. His base salary remained at $1.5 million, but due to public and political pressure, he declined to take a cash bonus for the year. However, what angered the public and lawmakers was the lack of transparency during the Merrill Lynch acquisition. Lewis knew that Merrill was facing massive fourth-quarter losses of around $15 billion, yet he did not disclose this information to shareholders before the merger vote. Moreover, Merrill paid out $3.6 billion in bonuses to its executives just before the deal closed, while Bank of America shareholders and the public were kept in the dark. These actions led to widespread outrage and an investigation. Lewis was accused of withholding key information from shareholders. By the end of 2009, Kenneth Lewis announced his retirement and he received no salary or bonus for the year 2009, though he left with millions in deferred compensation and pension benefits. Many see him as a symbol of poor risk judgment and lack of accountability in the lead-up to and aftermath of the crisis. As Bank of America scrambled to absorb the chaos, another giant was already deep in it. Citigroup's Vikram Pandit had a crisis of his own and a paycheck to match. Vikram Pandit became CEO of Citigroup in December 2007, right when the global financial crisis was intensifying. His arrival followed a period of massive losses at Citi due to its exposure to subprime mortgage-backed securities. In 2007, despite being CEO for only the final month, Pandit received a $3.1 million signing bonus, and his total compensation for that year reached around $38 million, including stock and option grants as part of his recruitment package. However, in 2008, Citi's situation worsened drastically. The bank reported over $27 billion in losses and laid off thousands of employees, and ultimately received $45 billion in TARP bailout funds from the US government to stay afloat. Given the public outrage over Wall Street compensation and Citibank's near collapse, Vikram Pandit accepted just $1 as a salary in 2009. He voluntarily committed to this symbolic figure and publicly stated he would continue to take only $1 annually until the company returned to profitability. This move was praised as a gesture of responsibility, contrasting sharply with other CEOs who still earned millions while their firms were bailed out. True to his word, Pandit was paid only $1 in 2009 and 2010, while Citi tried to rebuild its reputation and balance sheet. Once the company returned to profitability, Pandit's compensation increased. In 2011, he was awarded $14.9 million, but this became controversial. Shareholders rejected this pay package. Eventually, in October 2012, Pandit was abruptly forced to resign by the board. The official reason given was vague. Insiders pointed to differences between Pandit and the board regarding strategy and leadership style. But Wall Street's bonus culture didn't stop at Citi's doors. John Mack at Morgan Stanley also had his moment under the spotlight. John Mack started to lead Morgan Stanley as CEO in June 2005, and by 2006, the firm was thriving in the booming markets. In 2006, he received $41.4 million in total compensation, mostly in stock and options, as a reward for strong performance. In 2007, Morgan Stanley still posted a profit, though significantly dented by losses tied to subprime mortgages. That year, Mack received $1.6 million in salary but refused a bonus, stating that he wanted to take accountability for the firm's weaker results. It was a rare move on Wall Street. Then in 2008, Morgan Stanley's situation became worse. The firm lost billions in the credit crisis and narrowly avoided collapse after the Lehman Brothers bankruptcy in September 2008. Morgan Stanley survived largely because of a $9 billion investment from Mitsubishi UFJ and participation in the $10 billion TARP bailout from the US government. In response to the crisis and public backlash, John Mack once again declined a bonus for 2008, even though he remained CEO through the worst part of the financial meltdown. His total compensation that year was just his $800,000 salary. In 2009, Morgan Stanley slowly began to stabilize, and Mac announced he would step down as CEO by the end of the year. For that year, he again declined any bonus, receiving only his base salary. Over the span of the crisis years, Mac's decision to reject bonuses stood out compared to many of his peers, even though he had previously been awarded tens of millions during the boom period. Mac held the line at Morgan Stanley, but at Bear Stearns, it was a full-blown implosion by Jimmy Cain. Before the 2008 crisis hit, Bear Stearns was flying high. In 2006, the firm posted record earnings, and its stock was trading at around $170 per share. CEO Jimmy Cain was at the center of it all. That year, Cain made around $40 million, mostly in the form of stock and bonuses, reflecting Bear Stearns' strong performance in 2005 and 2006. In fact, from 1999 to 2007, Cain reportedly earned a total of over $300 million, mostly from selling stock. But everything began to fall apart in 2007. Two of Bear's hedge funds that were heavily exposed to subprime mortgage securities collapsed. Investors started losing confidence in the firm, and its stock began to fall. Yet, despite these warning signs, Cain didn't resign. In fact, during critical moments of the crisis, he was playing bridge and was unreachable. In 2007, despite the firm already being under stress, Cain still received about $34 million in total compensation, including bonuses and stock options based on the performance from 2006. However, as the firm's losses mounted in late 2007 and early 2008, pressure began to build. Bear Stearns was losing liquidity fast, and by March 2008, it was on the verge of collapse. In March 2008, JP Morgan Chase acquired Bear Stearns for just $2 per share, later raised to $10 per share, but still a massive collapse from its previous high of $170. Cain's personal losses were staggering. Though he had already cashed out hundreds of millions in earlier years, he still held a significant amount of Bear stock, which became nearly worthless. According to estimates, he lost over $900 million in stock value during the collapse. Cain had stepped down as CEO in January 2008, and Alan Schwartz replaced him just weeks before the firm was sold off. Even though Cain left with millions in prior earnings, the damage to his reputation was immense. Unlike other CEOs who stayed in power or received bonuses post-crisis, Cain did not receive a bonus for 2007 due to the firm's disastrous situation. And after 2008, there was no further compensation, as Bear Stearns no longer existed. If Bear Stearns was the warning shot, Lehman was the final blow. Richard Fuld led Lehman Brothers straight into history and still made millions on the way down. Richard Fuld served as the CEO of Lehman Brothers for over 14 years and was once considered one of the most powerful men on Wall Street. During Lehman's boom years, Fuld earned hundreds of millions of dollars, largely through stock sales and performance bonuses. Between 2000 and 2007, Fuld reportedly received about $484 million in total compensation, with a significant portion coming from stock options and sales. For example, in 2007 alone, a year before Lehman collapsed, Fuld earned about $40 million based on the firm's 2006 performance. Lehman posted record earnings in 2006, and the bonuses were awarded at the end of fiscal 2007. However, by mid-2007, cracks in the subprime mortgage market had begun to show, and Lehman's exposure to toxic assets was dangerously high. Fuld, however, remained aggressively confident, repeatedly assuring the public and investors that the firm was sound, though the firm's leverage increased and liquidity dried up. As losses mounted in 2008 and confidence eroded, Lehman tried to find a buyer or secure capital but failed. The US government declined to bail it out, and on September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy, triggering a global financial panic. At the time of the collapse, Fuld still held around 10 million shares of Lehman stock, which became worthless. Though he lost a massive amount of personal wealth on paper, he had already sold large chunks of stock in previous years. In later congressional hearings, Fuld was heavily criticized for his role in the collapse, but he defended himself, claiming that no one saw it coming and that he had always acted in the firm's best interest. Later, Richard Fuld became the face of Wall Street greed and denial, a CEO who made hundreds of millions while steering his firm into one of the largest bankruptcies in US history. The bonuses were just the tip of the iceberg. What really happened beneath the surface is far more disturbing. Check out this video where I explain the 2008 crisis from start to end.